Why liquidity matters more than wealth. Wealth looks powerful when everything is calm. Assets accumulate. Balance sheets grow. Numbers rise quietly on screens. But when pressure arrives, wealth often freezes, and something far less glamorous decides who survives. This matters today because modern financial systems are not tested by prosperity. They are tested by moments when confidence falters and movement matters more than magnitude. In those moments, it is not how much you own that counts. It is how quickly you can act. To understand why liquidity matters more than wealth, we have to separate ownership from usability. Wealth is value stored. Liquidity is value that can move. One exists on paper. The other exists in time. And time is the scarcest resource during stress. In stable periods, this difference feels academic. Assets can be sold. Credit can be accessed. Markets appear deep enough to absorb anything. Wealth feels liquid because nothing challenges it. But that perception relies entirely on calm. The reveal begins when conditions tighten. Buyers hesitate. Prices gap. Funding becomes selective. Assets that once defined strength become difficult to convert without loss. Wealth remains, but it stops responding. Liquidity behaves differently. It is not about total value. It is about immediacy. Cash on hand, reliable funding, the ability to meet obligations without negotiation. Liquidity does not promise long-term success. It promises survival. Institutions learn this lesson repeatedly. Firms with smaller balance sheets but strong liquidity endure shocks that overwhelm larger, wealthier counterparts. Not because they are richer, but because they can move when others must wait. This distinction reshapes behavior long before crisis arrives. Those who understand it prioritize access over accumulation. They trade some upside for flexibility. They value optionality more than scale. The early tension forms here. Wealth is visible and celebrated. Liquidity is invisible and ignored until it disappears. Systems reward growth during calm, but punish illiquidity during stress. And when stress arrives, it arrives suddenly. Liquidity does not ask what you own. It asks what you can do right now. And in moments that define survival, that question matters more than any balance sheet ever could. As the system expanded, liquidity became something many assumed rather than managed. Markets were deep. Credit was available. Assets could be converted quickly until the moment they couldn't. The difference between theory and reality emerged only under pressure. Institutions adjusted behavior accordingly. Balance sheets grew heavier with long-term assets. Funding structures leaned on short-term confidence. As long as markets cooperated, everything worked. Liquidity appeared abundant because it was rarely tested. Markets reinforced this illusion. High asset values created the impression of strength. Collateral looked solid. Leverage felt justified. The system rewarded accumulation, not readiness. Wealth signaled success. Liquidity felt unnecessary. The reveal deepened when conditions shifted. Not dramatically at first, just enough to change behavior. Buyers paused. Lenders tightened. Prices became less certain. Assets that once seemed easily tradable required discounts. Time entered the equation. This was the early conflict. Wealth locked in place could not respond. Obligations still arrived on schedule. Payments still came due. The system discovered that value without mobility offered little protection in moments that demanded action. Liquidity shortages spread unevenly. Some institutions moved freely. Others stalled immediately. The difference was not intelligence or scale, but preparation. Those who had preserved access survived. Those who had optimized only for growth struggled. The emotional tension formed here. The system had mistaken abundance for flexibility. It had treated wealth as if it were always usable. But usability depends on conditions, and conditions change faster than balance sheets can adjust. Liquidity is not created when it is needed most. It must exist before stress arrives. And the cost of maintaining it is paid during calm, when its absence feels invisible. The system was beginning to remember an old truth. Wealth impresses. Liquidity decides. The conflict reached its emotional peak when the system tried to convert wealth into action and discover how narrow the window had become. Assets still existed. Valuations were still reported. But movement slowed precisely when speed mattered most. Institutions faced impossible choices: sell now at loss, or wait and risk losing access altogether; borrow at punitive terms, or preserve dignity and risk insolvency. Wealth offered options, but liquidity determined whether those options were usable in time. Markets amplified the pressure. As more participants sought liquidity at once, it became scarce. Prices moved against sellers. Buyers demanded discounts. What it looked like depth vanished under demand for immediacy. Liquidity revealed itself as a collective condition, not an individual one. This was the heart of the conflict. Wealth is personal. Liquidity is systemic. It exists only as long as others are willing and able to transact. When everyone reaches for it simultaneously, it evaporates. The emotional weight of this moment came from recognition. The system had optimized for valuation, not for movement. It had rewarded accumulation without asking how quickly that value could be mobilized. Success had been measured by size, not by flexibility. Pressure concentrated where preparation was weakest. Firms with impressive balance sheets froze. Smaller, more liquid actors moved decisively. The hierarchy inverted. Survival favored readiness over scale. The buildup was complete. Liquidity was no longer a technical detail. It was a dividing line between those who could respond and those who could only watch. In that moment, the system learned again that wealth described potential, but liquidity determines reality. The resolution did not come from creating more wealth. It came from restoring movement. The system learned that survival depends less on how much value exists and more on how reliably that value can circulate under stress. The climax arrived when liquidity was deliberately rebuilt. Funding lines were stabilized. Market functioning was prioritized. Assets were reconnected to buyers. The goal was not to raise prices, but to reestablish trust in the ability to transact. As movement returned, behavior shifted. Institutions reconsidered what strength really meant. Flexibility gained value alongside scale. Access mattered more than accumulation. Liquidity was no longer treated as excess. It became essential. The resolution reshaped understanding of stability. Wealth could grow slowly. Liquidity had to be protected continuously. One could be rebuilt over time. The other had to be preserved before it vanished. The system began pricing this distinction into decision-making. What endured was a fundamental lesson. Liquidity is not about abundance. It is about reliability, about knowing that when action is required, action is possible. It is the difference between theoretical strength and practical survival. Modern systems forget this lesson easily because liquidity is expensive to hold and invisible when used. But every crisis brings the same reminder. Wealth can impress in good times. Liquidity decides in bad ones. And systems that remember this balance endure longer than those that chase size alone. Sometimes the smallest shift in perspective becomes the beginning of a new future. Why